Hey everyone, and welcome to today's Explainer. I am absolutely pumped to get into this one. Today, we're basically putting on our expert investment analyst hats, and we're going to apply a legendary valuation masterclass to one seriously fascinating stock, Lakeland Financial Corporation, trading under the ticker LKFN. We aren't just going to look at the stock price and call it a day. Oh no. We're going to systematically filter this company through the distinct, time-tested financial frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham before bringing the whole thing right into the modern era with discounted cash flow and comparative multiple models. We have a ton of fantastic data to unpack today, so definitely grab a notepad.
Okay, let's dive into the syllabus real quick. We'll start with a company snapshot, then run through the Buffett lens, the Lynch lens, and the Graham lens, followed by a modern DCF analysis, and wrap it all up with our final synthesis.
Section 1. Company Snapshot.
So what are we actually looking at today? Lakeland Financial is a regional bank holding company, and they primarily operate through Lake City Bank over in Indiana. Right now, it's trading at $61.83 a share, giving it a market cap of $1.54 billion. It's got a trailing price-to-earnings, or PE ratio of 14.5x, and it pays a really respectable dividend yield of 3.38%. Basically, this is a Midwest community bank pulling in revenue through commercial banking, retail, and wealth management, all backed by a healthy $5.4 billion loan book. So that's our baseline.
Section 2. The Warren Buffett lens.
When the Oracle of Omaha evaluates a stock, you know he's hunting for those deep economic moats, totally predictable earnings, and management he can actually trust. He famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." He wants exceptional quality, but he still needs that margin of safety. So does Lakeland meet his definition of wonderful?
Now, what's really interesting about this is how powerfully Lakeland lines up with Buffett's qualitative checklist. They recently reported a record Q1 net income of $26.5 million. But the real standout? It's their efficiency metrics. They boast a 15.2% return on equity and a massive 41% net margin. I mean, for a bank to turn revenue into profit at a 41% clip, that is absolutely exceptional. Plus, they maintain a highly manageable debt-to-equity ratio of just 0.1x. This is a highly profitable, conservatively financed operation. And here it is, the number Buffett would probably care about the absolute most. $106.58 million. That's Lakeland's approximate free cash flow over the trailing 12 months, which serves as an awesome proxy for Buffett's whole concept of owner earnings. This is the actual hard cash the business generates that could be handed right back to shareholders. A highly predictable cash engine with a 15% ROE? Yeah, Buffett would definitely be intrigued by this kind of quality. Provided, of course, the price offers a sufficient margin of safety, which we're going to test a bit later.
Section 3. The Peter Lynch lens.
Peter Lynch, the legend behind the Magellan Fund, focuses heavily on categorizing a company's growth relative to its valuation, and he closely watches what insiders are doing behind the scenes. As he wrote, insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will go up. He really wants to see management putting their own money on the line alongside some favorable growth-to-valuation metrics.
Running LKFN through Lynch's framework, we would definitely categorize them as a stalwart or a reliable dividend payer. Next up is the PEG ratio. That's price to earnings divided by growth. Lakeland sits at an insanely low 0.4x. Lynch would view this as highly favorable, since anything under 1.0 suggests the stock is undervalued relative to its growth. But honestly, the biggest green flag here? The insider buying. Director M. Scott Welsh recently bought 15,000 shares on the open market, injecting $1.4 million of his own capital at prices between $55 and $57. You combine that with a rock-solid 15.58% risk-based capital ratio, and Lynch's framework would likely rate this stock as a strong buy or a key elite.
Section 4. The Benjamin Graham lens.
Now we pivot to Benjamin Graham, the literal father of value investing and Buffett's old mentor. He strips away all those qualitative feel-good narratives. He just focuses entirely on hard math. His philosophy rests on this single idea. The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. He wants assets so cheap that even if the business completely stalls out, his downside is totally protected.
So, the crucial point is how Lakeland performs against Graham's famous defensive investor checklist. And well, it passes almost everything with flying colors. Adequate size? Pass. With over $7 billion in assets. Strong financial condition? Pass. Consistent earnings and a fantastic dividend record paying $2.04 a share? Pass and pass. It even has a moderate PE of 14.5x. But there's a catch with that last metric. Graham demands a price-to-book ratio of less than 1.5x. With Lakeland trading at 61.83 and a book value per share of 29.18, its PB ratio is 2.1x. So Lakeland actually fails his strict uncompromising value parameters.
We can actually prove this mathematically using Graham's famous intrinsic value formula. It's the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. Based on the data, our analyst assumption derives the book value per share by dividing their $758.8 million in total bank equity by the 26 million shares outstanding, which gives us $29.18. We plug that in alongside the 4.28 EPS.
And boom, the math spits out a Graham intrinsic value of exactly $53 per share. Because Lakeland is currently trading higher than this, at $61.83, Benjamin Graham would almost certainly pass on the stock today. For Graham, there's just no margin of safety here. He would literally need the price to drop well below $53 to even consider it.
Section 5. DCF and Alternative Valuations.
Okay, so Buffett's intrigued by the quality, Lynch loves the insider buying, but Graham is saying it's too expensive. To resolve this, we turn to modern corporate finance. A discounted cash flow, or DCF model, attempts to value a company based on the present value of all the cash it'll ever generate in the future. It's 3 simple steps. First, we take our base free cash flow of $106.58 million. Second, we forecast that out into the future and calculate a terminal value, assuming a conservative 2% perpetual growth rate, which is super standard for mature banks. Finally, we discount those future cash flows back to today's dollars using a 10% weighted average cost of capital, or WACC. When Simply Wall Street ran these exact projections through a DCF model, the fair value calculation came out to a staggering $99.67 per share. If we trust this modern cash flow projection, the current trading price in the low 60s represents a massive, massive upside and implies the stock is significantly undervalued. And this brilliantly illustrates how these things work. A DCF is highly sensitive to the inputs you choose. If we use our base 10% discount rate and 2% growth, we get that 99.67 target. But let's say we're feeling more pessimistic and assume an 11% discount rate and only 1% terminal growth. Even then, the fair value only drops to $78.10. So even in a pessimistic scenario, the DCF model still suggests the stock is currently undervalued at its current price. But hey, we can't just look at a DCF in a vacuum. Alternative models are key. When we look at comparable peers, Lakeland's 14.5x PE actually trades at a premium to the broader U.S. banks industry average, which is sitting around 11.5x. Alternative income models like a dividend discount model would also factor in their healthy 3.38% yield. But ultimately, looking at these comparative metrics, it seems the market is already pricing in that elite 15.2% return on equity. Like the old saying goes, you pay a premium for quality.
Finally, Section 6, Synthesis and Final Verdict.
This is where it all comes together, and it really shows you the complexities of stock valuation. Look at our conflicting data points. At a current price of $61.83, Benjamin Graham's math says it's overvalued, setting a hard ceiling at $53. Wall Street analysts view it as essentially fairly valued, with a median place target of $65.50. Yet the modern DCF model is screaming that it's undervalued, seeing fair value all the way up at nearly $100. To make a final call, we have to weigh the absolute strengths against the very real risks. The strengths are undeniable. You have highly successful insiders dropping $1.4 million of their own cash into the stock, supported by an elite 15.2% ROE, a 41% net margin, and an insanely low PEG ratio. But the risks are there too. You're paying a premium PE as compared to the industry, the $5.4 billion loan book is highly concentrated in localized Indiana markets, and the price-to-book ratio is pretty high for a traditional bank.
So our expert synthesis leaves you with this provocative question to chew on. Does the sheer quality of Lakeland's 15.2% return on equity, combined with that massive insider buying, justify completely ignoring Benjamin Graham's strict price-to-book limits? If you believe in paying a premium for a wonderful company like Warren Buffett, or you trust the cash flow projections of a DCF, this stock looks incredibly compelling right now. But if you side with Graham's historical, unyielding conservatism, you might just wait for a pullback closer to $50. The choice is yours. Thank you so much for joining me for today's explainer, and keep learning out there.